Well, welcome everybody. It's 4 o'clock and welcome to Baldwin's quarterly conversation. I'm Peter Havens and I have the honor of being the chairman of Baldwin Management. And with me today is a partner, Richard May. But first, we're going to turn it over to another associate, Christina McCloy, who is going to outline the rules of the road for us all. So, Chrissy?
Hi, everybody. I'm just give me a second here to share my screen. Okay. Well, welcome to Global Investing in a De-Globalizing World. This is our quarterly commentary. We appreciate you taking the time with us. I am just going to go over some of the rules of the road. We ask that while the presentation is happening, please just keep your systems on mute. This just helps minimize background noise so that it's not distracting from the conversation that's happening. If you have questions during the discussion, we ask just stay on mute, but go ahead. You can use the raise your hand feature to put yourself in the queue. I will see that and will stop the conversation, get you queued up for the question, and we'll go from there. How you raise your hand is at the bottom of your screen, you'll see a reactions button. If you click on that reactions button, there'll be a raise hand option. You can just click that. It will notify me, and then I will call your name in order. And then you do the same thing to lower your hand if you don't have a question either. That being said, if you are joining us by phone today, you can dial *9 on your phone, and that will also put you in the queue to ask a question. I will unmute you and instruct you to ask your question. When that is finished, you just dial *9 again, and that takes you out of the queue. That should be the rules of the road for now. We'll go back over those later. Also, if you have a question and you don't feel like asking verbally, there is a chat feature that you can use. You can type your question into the chat. I will then ask the question out loud and everyone will respond accordingly. And then let me just stop this for now, and I will pass this back to Peter.
All righty, thank you, Chrissy.
Yep.
So I'm now going to turn it over to my partner, Richard May, who's going to start off this conversation about investing in a deglobalizing world. So, Richard?
Thank you, Peter. The title is actually one that I conjured up because everybody, I think, is aware of what deglobalization is, the process that we're kind of going through right now. I've seen it described a little bit more academically as escalating geoeconomic fragmentation. Well, that's a mouthful, so deglobalization is a little bit more manageable. But what it really stands for is all the benefits and all the lowering of trade barriers that has been going on for literally hundreds of years, especially in the 20th century, has stalled to a certain extent, and to a greater extent, it's actually being somewhat undone by some of the recent developments geopolitically and geoeconomically. Peter wrote a quarterly commentary about this very subject that was called Connector Countries, How They've Saved Global Trade. And what we're talking about today is not only to set the stage of how this has happened and what is happening, but how to take advantage of this, what investment opportunities might exist in some of these connector countries that we should be interested in. So I will start off with a reference to Halloween. Somebody suggested I wear a mask today, but I thought you may not be able to hear me quite as well wearing a mask. But speaking of masks, China has been masking some of their recent policies. Their Belt and Road Initiative, which is providing a lot of capital and infrastructure around some of the developing nations of the world, is called by some a somewhat of a disturbing expansion of Chinese power around the globe. It's also been viewed as somewhat of a debt trap because they've been loaning money to countries, and then the debt service on some of those loans have been pretty onerous for some of those receiving countries. But that is another point in the sort of escalation of the disputes that China and the U.S. have gotten into recently with some of the geopolitical discussions. And it's forced many companies, as Peter pointed out in his letter, to take pretty dramatic steps to move their supply chains out of what had been an easy supply chain factory location in China into some of the more peripheral nations around Asia. You've probably heard the terms onshoring and nearshoring and friendshoring. Onshoring, pretty obviously, is moving production and assembly back to the U.S. Nearshoring is what's going on when a supply chain involves Mexican companies or even possibly some Canadian companies, but mostly Mexican and Central American. The friendshoring is a little different. And what that involves is finding countries that are sympathetic to the U.S. geopolitically and moving some production and assembly facilities into those countries. And so what we're going to look at today is how that happened and where we might find some opportunities going forward. Chrissy, could you put that first map up? This is a chart actually from Peter's commentary that really defines this thing very well. And let me sort of walk you through this. This represents the amount of global exports of goods and services as a percentage of gross domestic product. In other words, what percentage of the economic input is involved in the export community, and going all the way back to the 1840s. I'm going to get rid of my view. Okay. Going back to the 1840s, where we started off at a pretty measly 5% of product, we moved through the 19th century toward a more substantial share. It was set back by if you see the code up at the top, it was set back by the Opium Wars, which was the wars between Britain and China. It was set back again by the long depression of the late 1870s in both Europe and North America. And then again by the First World War, again by the Second World War. And then it began in the second half of the 20th century, a pretty dramatic increase from around 10% to up over 20% before stalling out, as you see up in the upper right-hand corner. The items that spurred this trade was China joining the WTO, but setting it back was the global financial crisis. And then basically, most recently, as I mentioned earlier, the Belt and Road Initiative has kind of dug into this percentage. So global trade has become increasingly important, but clearly what's happened here shows some of the recent problems. Moving to the second slide, Chrissy, if you don't mind. This is a really good map of Asia. Obviously, the bright red is China, but you notice how much of the rest of the Asia is a bunch of different countries representing non-China Asia. And we have relationships with a lot of these countries, and companies have relationships with a lot of these countries. And some of the assembly and manufacturing has moved into some of these countries. As is evidenced by some statistics. Chrissy, if you could move to the third chart, that'd be great. This shows pretty dramatically what has happened first to the Chinese share of global trade. Having, this was from early 2020 into 2023, and, or actually into late 2023, China's share has dropped from very close to 40% down under 25%, down to 24%. And meanwhile, India's trade has increased substantially, and Taiwan similarly has experienced, Taiwan and South Korea have both experienced an increase in global trade. More specifically, if you could go to the next chart, Chrissy. This shows by sector the increases and the decreases across the course in that same period of time. And as you can see from this, the financials have been substantially increased in information technology. And as we'll discuss with Peter in just a minute, there are implications for different countries depending on the industry that we're specifically talking about. So as an example, next slide, Chrissy. This shows the AI semiconductor demand by end market, which is growing at an astronomical rate. So obviously, technology is a big piece of this picture. To the next slide, Chrissy. As an example, you don't think of Vietnam a particular big technology center, but these are just the number of suppliers that are based in Vietnam. As China has withdrawn from some of the supply of goods for Apple in Asia, Vietnam has stepped up. Obviously, so has Taiwan and Korea, but this is a good example. So Vietnam, we're going to talk about a little bit later. And I think the last chart is in India. You can't mention Asia without talking about India. So India's year-on-year earnings growth, which has been pretty decent over the last 10 years, has all of a sudden surged. If you notice that last year's amount is above 30%. So you could argue India has now arrived. And what I'd like to do now is to really address what's happening to specific investment opportunities in Asia. So Peter, if you don't mind, I'm going to pose sort of a general question and would like, if it's possible for you to share with our participants what your perceptions are on, for example, passive investing versus active investing in non-China Asia.
Sure. The differential, I think, the primary differential is the amount of risk that an investor wants to take. Passive investing anywhere in the world, but in particular, say, some of the Asian countries, which are new to markets. Passive investing is most represented by index funds. And so you're gathering up all the names in a particular market, the good names, the bad names, and the indifferent names. And so it's a way to spread a great deal of risk. You're at the same time, you're probably also going to dampen your growth potential simply because the good names are going to get balanced out to some extent by the bad names. But if you go to a particular market and select particular stocks, you're going to obviously take more risk on. You'd have to have a very, very substantial portfolio to, within any market, generate a broad enough diversification so that you dampen risk. Now, that's not to say that stock picking internationally can't be fruitful. It can be very fruitful. That's what we do here. But we assemble a portfolio of international names which is broadly diversified, not necessarily in any one country, because we might have only 2 or 3 names in a particular country, but we could have 10 countries included in that last list and thus have 30 or 35 names in a foreign portfolio. So that's how we're going to achieve diversification within an international portfolio. not to the same extent as you would if you gathered up a bunch of index funds or ETFs, which represent in each of these, say, 10 markets. Then you'd have a basket of securities, which might be, good Lord, 500-600 names. But again, you're going to dampen return because you're including some bad names in addition with some good names. International investing, I've been doing it now for, good Lord, probably about 40 years. When I was first doing it back in the 70s, when I started my career, there was very little research that was available to investors. In the European markets, there were several British brokers that provided research. And so an investor could at least read a document, get some financial analysis done of a company, but there wasn't a lot of it. And Wall Street certainly really hadn't gotten into it. But then Wall Street decided that, in fact, international investing should be an important part of an investor's portfolio. And so now almost every house on the street has substantial international research. So now it's very easy to get lots of names written up and getting all sorts of opinions about their prospects for business in the upcoming quarter, the upcoming year, the upcoming 5 years. So it really has developed rather dramatically, and thus you are able to put together a portfolio of single names, but you can also use ETFs or various funds to do it just as well. It depends upon your view of risk.
Thank you, Peter. Just a comment that when we first started doing international investing and global investing at RKM, we used almost exclusively mutual funds. We're using a lot of ETFs now, but there were just a handful of fund families that actually offered international investing in those days. A lot of you might have heard of Templeton Investments. They had a fairly broad offering of mutual funds early in the process. We found the Matthews funds, which were specifically Asia funds, in the 90s, and used them quite liberally and quite effectively. That's kind of they've become less of a player as the category is broadened. ETFs have been a godsend because you can become more specific. More and more ETFs are now actively managed, and so they offer the average investor a chance to be internationally diversified. It begs the question, Peter, Asia versus Europe. We've talked principally about Asia. Europe is not yet. It's certainly not emerging, but I'm sure there's some supply chain redistribution that's taken place in perhaps Eastern Europe or even some of the European countries. What's your attitude about Asia versus Europe?
Well, certainly Asia provides an investor with much more economic growth. I've always believed that you start at the top, and that means, is the economy growing strongly or not? Because when an economy is growing strongly, then you have a better chance of finding more and more successful companies. So I would always, and we have historically, leaned towards greater emphasis on Asian countries to find names for investors who are interested in international investing. But don't eliminate the idea of European companies. As an example, Novo Nordisk was the first company, now this is a Danish company, was the first company to bring to market GLP-1s. And most people would know them as Wegovy or Mounjaro, so these are these weight loss drugs. Mounjaro is Eli Lilly's contestant in the race, but Wegovy is Novo Nordisk's entry into the race. But Novo was the first to bring these drugs to market, and that's a Danish company. Ryanair is, if any of you have traveled through any place in Europe, at most any airport, you're going to see Ryanair planes. Well, Ryanair basically is the most successful airline in the world today. They essentially took the Southwest airline model and moved it to Europe and have done a superb job of mimicking Southwest and sticking to their knitting. One thing Southwest has done is that they've sort of gone off the reservation a little bit and run into some troubles. So they've lost their crown as far as being a low-cost airline and allowed in some competition. Ryanair has stuck to its knitting, and as a consequence, they are the gorilla in the cage as far as so-called budget airlines in Europe. And they fly all over Europe. And as I said, they're now the largest airline. So there are certainly opportunities in Europe for successful investment. And as you also mentioned, a number of the Eastern European countries have become homes for manufacturing of Western European companies. So like the Czech Republic or Slovakia, they have various companies like Volkswagen and Mercedes, and steel companies like Thyssen have moved some of their operations to lower cost European labor markets to produce their goods there. And then they export them out of Slovakia, Poland, the Czech Republic, to the rest of Europe, and in fact to the rest of the world. So this as the world has opened up, capitalism has moved plant and product to the lowest cost horizon that managers can to take advantage of that cost differential.
You mentioned the individual companies. Are there accounting differences between European accounting and American accounting, and how does the average analyst or investment manager take into account those differences?
There are some accounting differences, no question about that. Europeans handle things like depreciation differently from American accounting. But I remember one of the arguments used to be back in the day, if you will, that, oh, well, European accounting was inferior to American accounting. And then we all had Enron happen upon the scene, and Arthur Andersen basically going belly up as a result of their Enron engagement and their effective participation in the fraud that Enron was. So that put to rest, complaints about complaints about European accounting and huzzas, if you will, about American accounting because it was superior to everybody else's accounting. Investing is not necessarily for the faint-hearted. You have to do your homework, or your investment manager's got to do his or her homework. So if they're going to go overseas to invest, certainly they'll be reading certified statements from various accounting houses. They'll be typically European accounting houses or branches of American accounting houses, which have recast numbers under IFRS, which are international accounting standards. But they just have got to have done their homework and know what those accounting standards are. And the good managers know how to read those statements.
When an investor owns either foreign companies through a mutual fund or ETF, or owns them directly, something that sometimes slips their attention is currency issues. I know that earlier this year, the Japanese market was substantially up, related in Japanese yen. It was substantially higher but the Japanese yen was substantially lower against the United States dollar. How important it is to first consider currency issues when taking a position in global markets, and secondly, do managers appropriately hedge against those currency fluctuations? I know some mutual funds do, and some mutual funds don't. So that's I guess, a judgment call.
Right. So yes, one should always well consider currency risk. There have been many papers which have been written over time which have suggested that a major part of the return generated by international investments is in fact currency related. And I would agree with that. I think that currency is important in the calculation. We don't hedge out our currency risk because we think our philosophy has always been international investing is a hedge against what most American investors have concentrated all their assets in, which is the US dollar. Now, for generations, for hundreds of years, that's been pretty much okay because the US has been the world's leading economy since certainly beginning in the early 1900s. We became the fastest growing economy in the world. And it could be argued whether it was post World War I or post World War II that we really achieved superiority to the rest of the world. Probably it would be safer to say it was post World War II because our major competition at that time would have been England, Germany, France, or maybe Japan, and all those economies had been devastated coming out of World War II. So we were the king of the hill. But on a going forward basis, and we've commented on this in the past, with the spending that we are doing as a country and the debt that we are taking on, we are threatening our reserve currency status, very much so. We're not going to lose our reserve currency status anytime in the near future because there is essentially no alternative. China can't do it because they have capital controls on the renminbi. The currency markets are not deep enough. They're not broad enough. Certainly the euro has tried. They're the second, that is the second largest currency in use in the world, but they've got a lot of internal problems within the Eurozone. The various countries bicker a great deal when it comes around to budget time. And there was a period of time in the like 2010, 2011, 2012, when the world was not sure that the euro was going to survive, that the European Union was on the brink of breaking up because its various constituents just couldn't agree on a path forward fiscally. Now under Mario Draghi, who was the European Central Bank head, he uttered a very famous phrase, which whatever it takes. And with that one phrase, the world started to believe that the euro was going to survive, and indeed, it did survive. But it's still not big enough. So for the time being, the US dollar is still king of the hill. For the time being, our reserve currency status in the world is still ours. But looking forward, we have said quite a few times, investors have got to be concerned about this. The US dollar does depreciate. It's not always going up. We've had a very strong dollar now for quite a period of time. But during my career, we have had several bouts of real dollar weakness when the world's currency markets, especially the world's bond markets, become concerned about our fiscal policies. And when that happens, the dollar starts depreciating and depreciates quite significantly. I remember when my daughter was in her last year of business school in Spain. So this would have been 2000. Well, I'm going to get it wrong. It was in the 2000s sometime. I top ticked the euro at 162 to the dollar. It's now at 108. So it's just to demonstrate that the dollar doesn't always go up. It does go down. So we think international investing and being unhedged in currency is the right way to do it, to hedge against what most American investors have is 100% of their assets tied up in the US dollar.
Thank you. That's a very optimistic and good answer. The one question that was raised in your quarterly commentary that I'd like to discuss before we get to sectors is some people view that that America's Pax Americana is under assault right now with the sort of cooperation of the Chinese and the Russians and the Iranians and the North Koreans. And the 70 years that we've enjoyed since the end of World War II as a terrific American sphere of influence is possibly under assault with the Chinese especially being a substantial competing economy. In your piece in the quarterly letter, you say markets may malfunction for a while, but ultimately efficiencies will return to a free market and inflation will subside. So that sounds like an optimistic view of these connector countries are really going to sort of do the job either while we reorient our supply chain or get the Indians to step into the place where the Chinese are currently operating.
I believe so. There's going to, in the initial phases, when you're beginning a transition from one production site to another production site, and in the meantime, establishing supply chains to all sorts of other vendors and then sub vendors of those vendors, it takes time. There's a learning curve. Yeah, you might have established a perfect world in around Chengdu in China, where you've got all your suppliers, you got the main factory and then all the various suppliers. But that took you 25 years to get that right. And now that it's right, and the wheels are humming very quickly, now you're going to move. Now, I don't believe that everything is going to move out of China at all, because most manufacturers want to supply the Chinese market. They're not going to give up that market entirely. But whereas what they've done heretofore is put the vast majority of their international manufacturing capacity in China, because it works so well, because the Chinese are very hardworking people. They're very mercantilistic. They're very capitalistic. I mean, they want to go after the gold. And so they changed all sorts of rules and regulations to promote the capitalist way in China. And it flourished in China. Well, there's been a change of policies. There's been a change of politics, and it's becoming much more unfriendly. So now you're seeing company managements make the decision to put future plants in places like Vietnam, Cambodia, Indonesia, Laos, and India in particular. And so in the initial stages, there's probably going to be something of an increase in inflation simply because there's going to be sand in the gears. The supply lines are not going to work flawlessly. The logistics are not going to work flawlessly. But we're going to get through that as these secondary venues, which could be primary in the future, depending upon how extreme China goes. India could well supplant China as being the primary international manufacturing hub in the future. But once it gets more established and once the subsidiary vendors are there and well established, then inflation will begin to come back down again. Because as we all know, one of the root tenets of capitalism is capitalists will seek out the lowest cost, best price for a particular quality product that they can anywhere in the world. And that's why international trade, as you showed on that first chart, Richard, that's why international trade has flourished through the years, through the decades, through the centuries, because people were always interested in seeing if they couldn't find a cheaper alternative, a better alternative, a more flexible alternative, whatever it was, whatever the beneficial characteristics of the alternative were, they were always going to try and find that to supplant a standard product, just simply because it was going to be better.
That's a perfect segue into sectors. That obviously certain sectors would favor certain countries, and we most of us know that the semiconductors, the main focus has been Taiwan, is try to get some of the manufacturing not out of Taiwan because they're enemies, they're friends, obviously, but that it's something like 85 to 90% of semiconductors have historically been manufactured in Taiwan. Obviously, Taiwan's a place that we can look to for IT servicing. South Korea, perhaps also, Peter. What some other examples of what would be the best company to benefit the people in Vietnam or Malaysia or even in Indonesia? Indonesia's got a huge population. I don't know how well educated they are, but could you speak to some of the sector implications of all this?
Sure. I think the countries that you cited, probably the one who's furthest along as far as a manufacturing site would be Vietnam. Malaysia is still fairly agriculturally based. Indonesia is very big in mining. They've got huge natural resources, both oil and gas and various minerals like iron ore and copper, et cetera, et cetera. So those are their particular strengths. In Vietnam, most of the companies there are some Vietnamese companies which have grown up. VinFast is an auto manufacturer. It's in EVs, and they're trying to steal a march on the Chinese EV, electric vehicle hegemony throughout Southeast Asia. In Malaysia, probably, since I'm not that much into agriculture myself, probably the banks would be a way to play there because they're going to be investors in the main industries in Malaysia. And I'm trying to think of a Malaysian bank. I can't think of one right at the moment that I would recommend. In Indonesia, it's going to be mining. And there, you've got companies. Pertamina is an oil and gas company there, and they've got significant oil and gas reserves. There's also there are American companies down there too, like Freeport's got a very big mine down there. But those would be some names that I would think of in those various areas. We've concentrated more in India, where we think that there's an extremely bright future as far as, we particularly think that that's going to be the logical place to replace China, if you will. And there you've got names like Emphasis, which is an IT company. You've got ICICI Bank, which is the second largest private bank in India. You've got Tata Motors, which is a major manufacturer of automobiles and trucks in particular. And when you think of a place like India with all of its bad roads and its infrastructure development, you want to think of construction, and that would lead to trucking because they got to haul materials around the country. So those would be some of the names that we would use there.
Well, it's interesting. Also, this works right into that. The statistics for what is growing most rapidly since 2005, services have increased by over 400% among the exports that are included in some of those statistics, whereas goods are gone up by 200%. So services are becoming a more dominant part of that export share of GDPs. Of those services, almost 30% are actually delivered digitally. That would, in my mind, certainly give an edge to the Indian companies, to the Taiwanese, and to the Korean companies. The question then becomes: are some of these services maybe a little bit less impacted by tariffs? I don't want to wander into the political argument, but obviously tariffs is something that could upset the apple cart. Any thoughts on the services, the goods versus goods, and the prospect of tariffs going forward?
I've not heard any politician talk about exacting a tariff on services. So like what Emphasis does. I've not heard anybody say, oh, we're going to slap a big tariff on it because we're trying to protect, say, Accenture, which would be a U.S. Competitor to Emphasis. So I'm not saying they couldn't do it. I mean, a tariff is nothing more than a tax. So you could just slap it on the bill and say, well, we got your bill is, $1 million, but you got to add 20% to it because of the U.S. tariff that we got to pay. So, but I've not heard that. Basically, all the tariffs that I've ever heard about have been exacted on goods. So some manufacturer, a car, a computer, chips, whatever. But that's where the tariff would be.
Yeah, there was a headline in the Financial Times just this morning about how is it BYD, that's the Chinese car manufacturer?
Correct.
And they're making terrific inroads in Europe, selling EVs, electric vehicles, to the Europeans. And the Europeans have threatened, I don't know what state this has gotten to, but threatened to put something like a 37% tariff on Chinese EVs coming into Europe.
Exactly. And it's very close to being enacted.
Wow. And apparently BYD has said we're still going to get just as many cars into Europe because we're willing to pay that tariff.
Mm-hmm.
It flies in the face of the contention that tariffs are in all cases paid by the consumer, because here's the company that's able to produce these vehicles so cheaply that actually they can pay the tariff in order to get that European customer to buy their car.
Well, if they're willing to do that, that's going to represent quite a conundrum for the European authorities, because they're obviously trying to protect their national champions, whether it be Stellantis or Mercedes or BMW or Renault or whatever. But if their cost structure is so high that they cannot compete against a Chinese company that's willing to pay 36% tariffs, then they probably ought to get out of the business.
As far as U.S. tariffs are concerned, when we were looking together at that first chart that we showed, that showed the impediments to the export growth, the Smoot-Hawley tariffs way back in the 30s, I think, did a job on export growth. Do you know much about the Smoot-Hawley tariffs and trying to stay away from current threats of tariffs? So Smoot-Hawley is probably a good representation of that.
Sure, sure. So the Smoot-Hawley Tariff Act was originally designed to protect U.S. agriculture. And after it had been around for a while, the politicians in power decided that, well, this was a terrific idea. It seemed to protect U.S. agriculture. Maybe we ought to spread it to everybody else. And the average tax rate was 20% under Smoot-Hawley. And so you saw what happened to international trade when that happened. Right now, the average weighted tariff in our country, even with the current tariffs that are out there, the average rate is 2%, because a lot of goods come into this country not taxed. So the tariff is on average over all the imports of goods into this country is only about 2%. So what one political party is suggesting is that across the board, a minimum 20%, and in certain instances as high as 60%. Well, that's Smoot-Hawley all over again. So we go from 2% up to a minimum of 20%, and in certain instances 60%. That's going to be bad for trade, very bad for trade.
Yeah. I noticed there's just an addendum on that fact of the 2% tariff. In 2000, the average was 5%. So from the year 2000 to the year 2024, that average has gone from 5% to 2%. So we've been reducing tariffs for things coming into this country over the last 25 years.
Yeah, yeah.
So that's
when you take a look at government receipts, because this is what we're trying to do. We're trying to find a way to get more money into the federal coffers to pay for various things. Well, 49% of the federal receipts are from individual income taxes. 10% comes from corporations. Only 2% comes from tariffs. So if somebody's trying to think about a way to replace income taxes, the numbers don't add up. They can't do it. You can't make that leap.
Oh, and also the problem with tariffs is you get a tit for tat. We put a tariff on European goods, and guess what? Next month, there are going to be tariffs on American goods coming into Europe.
Right.
And I assume that's what happened in Smoot-Hawley also.
Exactly. That's what it's. I've not so far seen an econometric model which would suggest that the numbers add up. When you do an interactive model where you look at, strategize about, forecast for reactions to an action that you've taken, the numbers just won't add up. So it's a very slippery slope that we would be going down if we were to enact broad-based tariffs and high tariffs, and we as a country ought to be prepared for that if that's what's going to happen, because there will be a reaction. There has to be a reaction, because as the Europeans are reacting to what the Chinese are doing as far as in the way of subsidizing their EV automobile manufacturing, the Chinese will respond to a 36% tariff on Chinese EVs by putting a 36% tariff on French wine, German wine, whatever it's going to be. But there will always be a reaction, and it becomes just a spiral, and it won't end well.
So we're very close to 10 minutes of the hour. We want to allow a few minutes for questions. If it's okay with you, I'm going to do a quick summary, and then Peter, if you could do the same. Although I'm worried about the transition from China being the manufacturing center for certainly U.S. companies to whether it's India or Vietnam or Malaysia, I am hoping it's not a um, an event that causes substantial disruption, but it wouldn't be surprised to see it reignite inflation to a certain extent. I think inflation's a little bit spring-loaded right now, and that a series of events could set off that inflation monster again. So I'm hoping I'm wrong.
Okay, from my vantage point, I wouldn't disagree with what you're saying, Richard, at all. But I think that there's an opportunity to take advantage of moving investments. If one is interested in international investing and one has been a successful investor in China, it was hard not to be a successful investor in China for a good long while because it was a very fast growing economy with some very dynamic companies. But at least for the foreseeable future, some might describe it, some have described it as China as uninvestable. So, okay, we need to move. And so where can we take advantage of where manufacturers are going to be putting new plant and equipment to again satisfy the world's desire for the cheapest product, best quality product for the money, and look to those countries and their markets to participate. And that would have to be places like Vietnam, Indonesia, Poland, and in particular, I think India. So we can cry about China and say, woe is me and boo hoo. But we can also then take advantage of where the ball's going to be bouncing next, whereas Gretzky, the famous hockey star, said, I go where I think the puck is going to go.
Perfect metaphor. Thank you. Any questions, Chrissy?
Currently don't have any in the queue. Just as a reminder, if you do have a question, you can click on that reactions button and the raise your hand feature, and I'll see you in the queue. If you're by phone, you can hit *9. It'll also put you in the queue for a question. Or you can type a question into the chat and I'll read that out.
While we're waiting for questions, Peter, I'd like to pose, the Financial Times this morning also had a letter to the editor, talked about something called Knightian uncertainty. And I had never even heard of this before. There was an economist in the 1920s who described people being so uncertain of possible outcomes ahead that they're paralyzed at the switch. And it makes me think that maybe some investors right now, looking at the possibilities with the geopolitical situation, 2 wars going on and a US election about to happen, are paralyzed at the switch. Do you think there's any credibility for that?
When you say the switch, I'm not sure what switch
at the trading, rather than trying to make a trade to mitigate that risk, they're frozen. Rather than trying to figure out whether to buy, sell, they're just literally doing nothing.
Oh, okay, all right. Well, quite often doing nothing is probably the best strategy that one can take. Our partner Gary Hess put out a couple of very interesting charts yesterday, which clearly demonstrated, and this has been argued by countless authors and academics for quite a long period of time, but people have a tendency to forget. So they want to interject politics into the markets, and what influence is politics going to have on markets, or what effects are wars going to have on markets? What effects are major events going to have on markets? And what has been demonstrated over time is that certainly politics has got no influence on the outcome of the markets. And even major wars. I mean, good Lord, we've got 2 wars going on right now in the world, and neither one has had any influence on markets. In particular, the war in the Middle East, back in the 70s, had that gone on, the price of oil would have been at $150 a barrel. Today, the price of oil, which everybody says, oh Lord, if there's going to be a war in the Middle East, the price of oil is going to go through the roof. The price of oil is at around $70 a barrel, and it's actually down this year about 6%. So the advice that I think we have quite consistently given to clients is stay invested. Don't try to time markets. Don't try to guess which way some election is going to influence things, because in the long run, and we're all investors, long-term investors, that's the definition of an investor, not a trader. Long-term investors are better to stay in the markets. If you miss, I think there's a statistic out there that, something like if you miss the 20 best days in a market over a cycle, you've left out something like 60% of the gain. So you really damage returns and results by trying to time things.
Yeah, there was one question, kind of fits with what you're talking about. It says, any thoughts about how things might change if the election results in tariff chaos?
I didn't hear quite the what?
Any thoughts about how things might change if the election results in tariff chaos?
End tariff chaos?
If it results in
result
chaos.
in tariff chaos.
Yeah.
Well, as I said earlier, we've got an example from history. Those sorts of draconian tariffs have not played well in markets. Now, we're nowhere near there yet. And while I believe the president does have the power to enact tariffs, I think if it were to go to the extreme that some people are talking about, I think they would have to get sign off from the Congress. I don't think it could be done unilaterally. So we would certainly have time to get prepared if we were to go down that sort of a high tariff path.
And historically, investors have been pleased when there's been a split government, because that usually means that we're not moving massively in one direction or the other.
Exactly.
There are no other questions.
Perfect.
No.
3 minutes of 5.
Good timing.
Thank you for your question, Mike.
Okay, well, if there are no other questions, Richard, many thanks for the conversation. I appreciated it.
It was my pleasure, and we'll continue on next quarter.
Okay, thank you all for your attendance and for your attention. Take care and have a very, very happy Halloween.